Investing is the secret to building wealth. And if you're looking to place $1,000 somewhere this year to make it much bigger, then you're in the right place. However, this entirely depends on whether this is the only $1,000 you're planning to invest, or if you'll have $1,000 now and will consistently have more in the future. Welcome to Wealthway, and today, we'll explore your options based on your investment goals. Let's get started. If you've saved up $1,000 and are planning to invest it in the stock market or even riskier assets, congratulations! You're taking a step that many people don't. However, if this is the only $1,000 you plan to invest for a while, there are some important considerations. Let's imagine you invest your $1,000 in the stock market, and in a good year, it returns 25%. That's 15% above the average, and professional investors would be thrilled. But for your $1,000, it would only yield $250, which might not significantly change your life. Placing your money in a savings account might seem like a safe option, but as of February 2023, the average return through a savings account is a mere 0.33%. After 5 years, your $1,000 would grow to just $1,106. While it's guaranteed, it won't help you build wealth. Certificates of deposit offer slightly better returns, with an average rate of 1.37% for a 5-year term. However, your $1,000 would only grow to $1,068 after 5 years, not a significant gain. Even if you were to invest in the stock market for 5 years with an average return of 7%, you'd still only end up with $1,400. While better, it might not have the impact you're hoping for. So, what can you do to make more money, to invest more money and grow your wealth? The best investment you can make is in yourself. As Warren Buffett said, anything you do that invests in yourself is the best investment you can possibly make. You can start by acquiring new skills through books, webinars, seminars, or courses. Skills like marketing and coding are becoming highly valuable assets in any industry. The more valuable you are, the more you'll be paid. Investing in yourself is a lifelong journey. As Charlie Munger advises, develop into a lifelong self-learner through voracious reading. Cultivate curiosity and strive to become a little wiser every day. Another way to make more money is by creating another income source. Thanks to the internet, it's easier than ever to start a side hustle or a small online business. Invest your time and effort into something you're passionate about and watch it grow. You can use the money you make from this new income source to either invest in your business to help it grow or to invest in the stock market for long-term wealth building. If you have a steady income, saved up $1,000 and plan to add more money regularly, you should aim for passive income. This means putting your money to work for you while you continue to earn. The concept of passive income is like having an automated money-making machine. It's a financial strategy that allows your investments to generate earnings with minimal effort on your part. This approach is particularly appealing if you want to build long-term wealth without constantly monitoring your investments. Passive income is a crucial element in achieving financial independence. It can provide you with the freedom to pursue your passions, spend more time with your loved ones, or even retire early. The key is to create reliable income streams that require little ongoing effort. When it comes to the stock market, consider Warren Buffett's sage advice. The best single thing you could have done on March 11, 1942, when I bought my first stock, was just buy an index fund. Index funds offer an excellent avenue for passive investors. These funds track the performance of a specific market index, like the S&P 500 or the Nasdaq. By investing in index funds, you effectively own a small portion of every company in that index. Let's delve into some popular types of index funds. First, there are general market funds such as VOO and SPY. These funds provide exposure to the broader stock market including the top 500 companies in the US. When the US economy thrives, so does the value of these funds. Conversely, if the economy struggles, the fund's value may decline. If you're drawn to the tech sector, consider VGT or QQQ. These tech-focused index funds expose you to companies like Microsoft, AMD, or Google. As technology continues to advance, these funds can potentially yield substantial returns over time. For investors seeking regular income, dividend-paying index funds like VYM or SDY are attractive options. When you invest in these funds, you gain exposure to a basket of companies that consistently pay dividends to their shareholders. This can provide a steady stream of income, making it a valuable addition to your passive income portfolio. One strategy to maximize the effectiveness of your investments is to automate them. Whenever you receive a paycheck, consider allocating a portion, perhaps 10% to 15%, directly into your investment account. This automated approach ensures that you consistently contribute to your investments. Following Buffett's wisdom, do not save what is left after spending, but spend what is left after saving. Keep in mind that building wealth through passive income takes time. The real magic happens through the power of compounding. Over the years, your investments can grow exponentially, generating more income and wealth. Real estate can also be a great long-term investment. While $1,000 won't buy you a rental property, you can explore crowdfunding real estate platforms. These platforms allow you to invest small amounts with others to fund real estate projects, and you share in the rental income and property value appreciation. Additionally, you can invest in real estate investment trusts. REITs are companies that own and manage income-producing real estate, and they often pay higher dividends to investors. Some popular REITs include VNQ and USRT. They provide a way to invest in real estate without owning physical properties. If you're not ready to invest or prefer a different approach, consider paying down your debts. High-interest debts can be a significant financial burden. As Warren Buffett says, you can't make progress in your financial life going around borrowing money at 18% or 20%. Paying off debt early is just like a return on investment. For example, if you have a loan with a 4% interest rate, paying it off a year early effectively earns you a 4% return. In conclusion, how you invest your $1,000 depends on your financial goals and circumstances. Whether you choose the stock market, invest in yourself, create another income source, explore real estate, or pay down debt, remember that building wealth is a journey that requires careful planning and dedication. Thank you for watching, and I hope you found this information helpful. Please like, share, and subscribe for more financial advice and investment tips. And as always, do your due diligence and make informed decisions. Your financial future depends on it.